We have an analysis report on that massive surge in ARWIA Inc., ticker YYAI.
Mm-hmm.
The analysis covers the, 20% plus pop, arguing its pivot from a sports equipment maker to an AI-powered real-world assets exchange is this huge high-risk, high-reward bet. So let's get straight to the feedback. Okay, so the report does a really good job of capturing the speculative energy here. You can feel the hype. But to make the bull case truly solid, we have to start with the most basic thing, the money, the capital.
Exactly. The analysis needs to provide much greater specificity regarding that $100 million commitment from JuCoin and, how it's actually structured.
Yeah, I agree that's foundational. The material mentions the $100 million commitment, and it notes that about 30 million of it was paid in Solana, in SOL tokens.
Right. And for a microcap, that initial 30 million is a massive lifeline.
It is, but that leads right to the core problem, doesn't it?
It does. Because for a stock this volatile, with a tiny, $24 million market cap, the entire surge is built on future promises. This ambiguity is it's a critical flaw.
So the question is this 100 million secured capital? Is it liquid, in the bank, ready to be used?
Or is it a conditional promise? Is it tied to milestones that, they might not even hit?
And that lack of clarity, is that intentional from management to keep the hype going? Or is it just a gap in the analysis? Because for a stock like this, capital clarity is everything.
It's non-negotiable. Without knowing that, the whole bullish thesis, which really hangs on them having years of runway for this big tech pivot, it's just not supported.
It leaves a huge, unquantifiable hole in the analysis. I mean, we're talking about a $24 million company that wants to build a global financial exchange.
And we don't know if they have 30 million in cash or just 100 million in promises. The weakness is just not defining the capital they actually have versus their burn rate. So the actionable suggestion is simple. Kill the ambiguity. Just eliminate it. The analysis has to clearly define the terms of the investment. If it's a commitment, we need to know the specific milestones for releasing the rest of the cash.
And are those milestones even realistic?
Exactly. And if the money's already there, the report needs to confirm the current liquid cash position against their projected burn rate for the next, say, 18 to 24 months.
This is so important when you think about the pivot itself. Building a compliant RWA exchange isn't cheap.
Not at all.
They're going from gym equipment to global finance. The spending on compliance, security, engineers, it has to be astronomical compared to what they were spending before.
It is. So let's give some concrete examples of how to tighten this up. Instead of just saying YYI secured a $100 million investment commitment.
Right. The analysis needs to be more specific. Something like YYAI has drawn down 30 million in SOL tokens, confirming a stable cash position, but the remaining 70 million is tied to achieving phase 1 operational milestones for the exchange launch. And then you define those milestones, like 50 million in tokenized assets under management or securing a specific license.
Yes, that reframes the entire investment. It's not a headline number anymore. It's a structured roadmap. It turns the JuCoin money into a performance incentive, which is way more insightful.
And that has to tie directly into the burn rate. The report notes the TTM revenue is about 12.8 million, and that's all legacy sports revenue.
So given that and the massive new costs, the analysis has to quantify it. How long will that initial 30 million actually last before they need the next chunk of funding?
That turns the burn rate from a fuzzy risk into a hard deadline. It does. It forces a timeline on their success. For example, the report could say, based on projected Q3-Q4 2024 expenses of 8 million a quarter, the initial cash provides a runway of about 3.75 quarters. Therefore, the first milestone must be hit by the end of Q1 2025 to avoid emergency dilution. Something like that.
Exactly like that. It grounds the whole thing in an actionable risk metric.
That kind of specificity changes the report from just a general idea into a detailed investment checklist. It brings some sobriety to what is, a speculative frenzy.
Precisely. And speaking of that frenzy, that lets us move to the second big issue here, which is the tech itself, the engine of the hype, the AI.
The claim of AI-powered tech is driving this entire re-rating, but the analysis doesn't establish a real competitive moat based on what that AI actually does. I see where you're going. The market's applying a huge AI premium here. It's the only reason a sports retailer gets a 20% jump on a press release.
Right. But the analysis says the AI function is just matchmaking originally built for dating and sports apps.
Which is useful information. It tells us where it came from, but In this context, it kind of positions the AI as just a feature, almost a gimmick, not a defensible differentiator.
Wait, can we just pause on that for a second? Are we supposed to believe that the tech used to match people for a tennis game can be directly applied to routing millions of dollars in regulated assets?
Isn't that a massive red flag? The analysis should be digging into that, not just stating it as a fact.
It absolutely is, and the report should use that skepticism to its advantage. I mean, in the crowded fintech space, just saying you have AI matchmaking doesn't justify the valuation left.
The whole bull case is RWA tokenization and 24/7 trading. The connection between this old dating AI and a high-frequency, regulated financial exchange needs way more rigorous exploration.
So the weakness is that the report just accepts the AI claim. It doesn't show how it actually improves the RWA transaction experience compared to what's already out there.
If the AI is just a feature, then the premium is based purely on a buzzword, not on fundamentals.
Exactly. And you risk missing the technical application if you only focus on the history, but the report has to bridge that gap.
So the suggestion is to go deeper, explain why this specific AI gives them a real quantifiable advantage over other exchanges or RWA platforms.
Yes! Reframe the AI completely. Shift it from a historical footnote to the key future competitive advantage that's going to win them market share.
That narrative shift is where the report builds its credibility.
And you need concrete examples that connect the AI to the core challenges of RWA. The RWA market is fragmented, it's illiquid. If the AI is so essential, explain how it solves those specific problems better than a non-AI solution.
Okay, so let's brainstorm. How does it turn a slow, fragmented process into a high-speed one?
Well, one angle is to focus on counterparty risk and speed. For instance, the report could say something like, the AI algorithms minimize counterparty risk during 24/7 global transactions by preemptively routing orders through deep liquidity pools, ensuring settlement speed that traditional RWA platforms lack. That's it. That's not a feature. It's a necessary piece of infrastructure for global RWA trading.
And that validates the premium. It turns the AI from a buzzword into a process enhancer that's actually solving a market failure, not just making the UI look nice.
And if the analysis wants to keep the dating app origin story, which is memorable, it needs to challenge it head on.
Make the pivot sound difficult, not easy.
Right. If it came from dating apps, what specific, expensive engineering steps did they take to repurpose it for financial compliance, for speed, for security?
That is a huge point. The leap from matching interests to minimizing slippage in high-frequency trading is massive. The analysis has to prove they actually made that leap.
If the analysis can say, management spent $15 million and 18 months re-engineering the latency profile and integrating KYKML compliance hooks, then the pivot is believable. It's not just marketing spin. Which brings us to the third and final area. This is the elephant in the room. Given all this ambiguity around the capital and the AI moat, how do you even value a company like this?
Well, that's the core problem, isn't it? The valuation section is stuck between the past, the struggling retailer, and the future, this AI tech exchange.
Right.
The material needs a creative framework, a valuation model that can actually bridge that gap.
The analysis points out the difficulty. It says trading at about 1.8 times sales is low for tech AI, but high for a struggling sports retailer.
Which is accurate, but it doesn't answer the question. It just states the problem. What is the right valuation methodology for a transitioning microcap? Using a price-to-sales multiple on legacy revenue is frankly useless here.
The weakness is that the valuation doesn't offer a practical solution. The suggestion then is to introduce a segmented or maybe a milestone-based valuation approach.
Something that lets the analysis model the potential market cap based on future success, not on current, irrelevant metrics.
That's the only way to validate the risk-reward here. You have to show the math that gets you to that $1.50 target they mentioned.
Absolutely.
The analysis should just abandon the single metric approach and use a sum of the parts framework, an SOTP. That's crucial for isolating the speculative value.
The SOTP method lets you, what? Put a price tag on the gym sock division and then separate it from the AI exchange?
That's exactly it. Assign a minimal residual value to the legacy business, say $5 to $10 million. That's your floor. Then you apply a dynamic, scenario-based valuation to the new exchange part. That clearly isolates what an investor is actually paying for, the new vision and all the execution risk that comes with it. It provides that mathematical separation you need.
It acknowledges the old business exists but doesn't let it drag down the potential of the new one.
And then, the analysis needs to use a focused benchmarking approach. Don't compare this to Amazon or Apple.
Of course not.
Compare it to other RWA platforms or similar pivot stocks. Look at early-stage digital asset exchanges.
That makes the growth assumptions much more grounded in reality. So, for instance, the analysis could lay out a scenario. If the RWA exchange captures just 0.5% of the estimated $10 trillion RWA market in 2 years, generating $150 million in revenue, and you apply a conservative 10x forward multiple, comparable to other early-stage exchanges.
The implied market cap for the exchange alone should be $1.5 billion. Add the $10 million from the legacy business, and that suggests a potential stock price of $6 a share.
And suddenly, that $1.50 target looks like a conservative first milestone, not just some random line on a chart.
It moves the target from a psychological level to a mathematically supported possibility. That is incredibly powerful.
It validates the risk.
It does. The core narrative here is strong. It's a lottery ticket on the future of finance. But the analysis report needs to prove that lottery ticket has a real structural chassis, not just a flashy paint job built on hype.
This is incredibly helpful.